We're going to specifically look at Walt Disney Corporation because it's the biggest company in this industry and probably the oldest company which exists on the market. Now, a bit of history of Disney. So it was established in 1923 by Walt and Roy Disney. For whatever reason, I thought last night it was Roy Disney. And they started Disney Brothers Cartoon Studio. Actually, before that, Walt got bankrupt because he previous venture because he wasn't profitable. And actually, until 1928, they barely could make money. Their first cartoon was Alice in Wonderland, and they barely could survive. And only after 1928, when they got Mickey Mouse, like series, they started making money because when you produce series, you kind of get a recurrent income, and you don't have to spend quite a lot of money and effort for promote yourself. In 1934, they moved from cartoons to the movie, and their first movie was Snow White and the Seven Dwarfs, and it's good because they kind of promoted themselves, and after that they had few more movies, but that was the first movie. In 1946, after Second World War, they managed to negotiate and they created a TV series. And here, Coca-Cola helped them to do that, and they kind of promoted it together with Coca-Cola, and they created very popular series. And now we're in Wonderland, Disneyland. So, and all their characters, they created a lot of characters which you know now uh, during that time. And as a result of that, when it's become so popular in the United States, they opened the first Disneyland park in 1955. And after that, it's become one of the best kind of business ventures for them because majority of people know business like Disney by Disneyland parks. Okay, and after that, already in 1980s, there fast expansion in other area of business. So it's TV networks, distribution channels, licensing, and etc. 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 So they start expanded quite strong, and also they started expanding internationally. They were going to Europe, China, like Asia, and etc. etc. Okay, that's the history of Disney. Now, before I go to next slide, I want to ask you what kind of what do you think? I know that Ian and Ona they already know that because we looked at this last night. But guys, Dean, Fraser, and Sergey, if you could answer what area of business the most, like the biggest in Disney, in Walt Disney Company? What do you think? Where they generate the highest revenue? If you have your value line report, don't look at this now. Okay, Dean put parks, Fraser films, and Sergey licensing. Okay, cool, interesting, right? So that's how majority of people perceive Disney. And but in reality, if you look at Disney, you will see that Disney Media Networks, it's ABC and ESPN, creates 44% of revenue. So it's not a movie production. And studio entertainment, that's why a movie production is only 14%. And 31% it's parks. So Dean, you were kind of mostly right. Yeah, but in any way, so imagine practically half of the business generated by media networks. ABC and ESPN. And ABC, they have quite a lot of subsidiaries there, international subsidiaries, US subsidiaries. They also own some sport channels, etc., etc., etc. Okay, that's why. And knowing that, we understand why the price dropped from $120 at the highest, and now it's $92. So it's like $30 on a $120 company. So it's about what 25% drop. Okay, and for us it's important to know why, because when you look at value line, you will see that they're saying that they lost about 1 million subscribers to these channels, to these networks, and that's the reason of people kind of not feeling very comfortable in investing in Disney businesses and the price drop. Okay, another thing about parks and resorts, they have different parks. They have Disneyland, Walt Disney World, but it's good to know that they don't own all of them. They own only three of the parks. One is in Florida, in Orlando, then in I think in the Hong Kong as well, on in France, and now they built a new one in China. So it's like four parks they own. Another 14 they're licensing, so they get royalties from other 14 parks across the globe. Okay, and also they have a cruise line where you go on a cruise and you enjoy all these characters as well. And movie production is 14%. Another question which I asked last night is about what kind of movies do you think produces Disneyland? Is it mostly related to children, adults, mixed? What kind of movie, guys, do you know Walt Disney Company produces? Okay, mostly for children, 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 but also comics. Okay, Marvel. That's excellent, Dean. You know that. That's good. That's true. Majority of people don't know. I love Marvel movies. I just love this type of movies with all these superheroes. And I decided once to research Marvel, and I tried to find it. I couldn't find it. Like Ticker, it didn't exist. And then I realized that it's subsidiary of Disney. Disney bought Marvel, so it's fully owned by kind of it's part of the Disney company. So sometimes we even don't know something like sport channels. Sport channels, it's mostly for adults and it's owned by Disney. So Disney is very diversified company. So and the way they lead their customers, they're trying to attract customers to their network, to their cartoons, through different children books and etc. etc. And then they lead them to the adult world. Okay, so that's how interesting they're building the loyal customers. Okay, in this particular case, and also they get different consumers products, and you understand that there are a lot of games now related to Disney characters, and I'm sure if you have kids and maybe they go to smartphone or tablet or computer, they will find all these games, and that's also rather licensed by Disney or owned by Disney, and they generating revenue on that as well. Okay, so do you have any questions, guys, or if everything clear, put a green tick regarding like Disney businesses, and then we'll go to fundamentals. All right, so let's go. Now, fundamental analysis of Disneyland. So what we can see always when I look at value line report, very often I start from 2008. It's kind of important part because there was a crisis there, and for me, it is important to know if the company managed to go through this period easily or with trouble. Okay, and we can see that their sales level was $18. It was growing before that, steadily growth. Okay, and then in 2008 from $20.76 it went to $19.88. So it's like quite low, less than a dollar, like about less than a dollar drop down. So it's about 4.5% reduction in revenue. If we look at earnings, which were growing steadily before that as well, actually not in 2000 as well. So and we can see here the drop about 20%. So it's not that big a drop. And we understand that mostly probably parks were affected by this. People wouldn't go to the parks and pay quite a lot of money for this. By the way, who went to any different park like that? Who experienced that? Disneyland or maybe other type of park, Universal Studio, Warner Brothers. Okay, Sergey. Okay, Ian and Anna. Anyone else? So you know that is quite expensive. It's not that cheap. All right. And I remember I went in Orlando to this park and I had to pay for fast line $130. And then we still were queuing and it was packed by people. So people pay this money. But I imagine if you're not alone and if you're going with kids, three kids especially, like you pay for kids, you pay for yourself. So it's like $1,000 for a day gone. I mean, because they're not only paying for park, after that you have to buy food and all these extras which they're trying to sell you within the park as well. So it's quite expensive to go there. But uh, you can't do anything. Our kids want it. So and probably that was affected. Also, I presume people wouldn't go for cruises, maybe something like that. But in general, I mean, you would be watching movies. You will be going to the cinemas. You might not going for holidays, but you're still going to spend a few bucks in order to rent the movie or buy the movie or maybe to go to the cinema, etc., etc. So that's why this type of business, and also you're going to watch TV, and also you will be exposed to advertisement. So that's why company is pretty stable in this particular, and it's good for us. So because if we expect something like that in the future, we need to know that our investment is protected. And after that, what we can see, constant growth, steady growth, $20, 23, 23.40, 25, 28, 32, and they're planning to have a sales level of $34 during this year. From the earnings perspective, similar story. After 2008, we have steady growth. Okay, 180, 27, 250, 3, 330, 4, 490, 575, and they're expecting to grow in the future. So it's a good kind of point to know for us. Also, if we look at book value, we can see book value is growing, but I told you that you need to pay attention to book value. Now, let's have a look straight away maybe, and I just see if I have it opened. Okay, let's open here. I usually go to Finance Yahoo, and you type here Disney. Okay, here we actually, by the way, pay attention. Pricing ratio now 1665. We will need it in the future. All right, beta is quite volatile here, 1.4. It's different from value line report. Okay, but for us, it's important to go to financials, and we go to balance sheet. Now, what we can see here, that's current assets. Okay, and we can see also current other assets, and we can see that goodwill is 27 billions, and intangible assets 7 billion. So what kind of intangible assets we can expect here? Because they are buying other networks, probably they buy some licensing, patents, and etc., etc., right? So they put it as intangible assets. If they cannot anyhow identify that type of patent, so it's called goodwill. And we can see it's growing goodwill, so it's getting bigger. Okay, and actually for the last year it's dropped down a bit, but it was growing. So every time when they buy a new company, goodwill is getting bigger. For us, it is important to know what size from total assets. And if we look at total assets, it's $88 billion. And then we add goodwill and intangible assets, which going to be 34 billions. So we can expect that it's nearly what? 35%, right? More than nearly 40% of assets are intangible assets. So whenever a company is going to, like for example, liquidation, it's not related to Disneyland. Disney is such a strong company. I don't think it's going to get any close to bankruptcy. But if you analyze any other company in this industry, you have to pay to this attention. You have to pay to. Now, another thing you also need to take into account, if the company is producing any content which they license after that, you won't see this on a balance sheet, because when you produce something, so for example, if the company is a innovative company and they have a huge research and development team and they constantly produce any know-how, this know-how they cannot put on a balance sheet unless this company is sold. Okay, you can put all this know-how on the balance sheet only when you buy something. That's the interesting thing about accounting. So that's why companies like Nokia, for instance, they have strong research and development team, and they research it themselves. And very often, when you analyze company Nokia and you look at their balance sheet and their assets, you won't see those know-hows on their balance sheet. And you need to know if they start selling it, they will get quite a lot of money for this. But you won't see it if you don't know the company, what they're researching. So, okay, so you have to take into consideration. Now, good, right? So we look at this. If we go back to Disneyland, So another part, we look at their debt. The debt is quite high. And also what I pay attention, sometimes I was asked, where do we pay attention, long-term debt or total debt? I look at both figures. Now, for us, it's important long-term debt. But if you see this huge difference, look at this, 21 billion of total debt and 15 billion of long-term debt. It means that its current debt here is nearly 6 billion. And 6 billion is, as a current debt, it's not a good thing. And we can see here, account payable here, it's $7 billion. It's That's kind of not a good sign. Like, I mean, for the company of size 157 billion, maybe it's not that bad. But I mean, in general, when you see, it's much better to borrow more money and transfer it to long-term debt rather than to have such a huge amount in short-term debt, because all this has to be paid within next 12 months. Now, in this particular case, when you see something like that, always look at what kind of revenue they have. Can they cover it during the next year earnings? And we can see that they expect $9.5 billion of net profit. So it means that they will be able to cover it easily within next year earnings. So it's safe for us. Okay, so that's the most important part, because if we see that some debt coming to due and the company has to pay and they have no money to pay that, that would be trouble for us. And in our particular case, what we can see here, we can see $5 billion in cash, also receivables and etc. So together we have 17 billions in assets, and we have about 17 billions in liabilities. Even liabilities a bit more. Okay, so it's not a good thing. We prefer that current assets always higher than current liabilities, so that we can get cash and pay your like suppliers and whoever you need to pay from current assets, not borrowing money. Okay, so this is kind of minus for Disneyland. Okay, we need to know that. Another thing which we pay attention is growth. Now we can see that, and we need to understand that if the company is $157 billion by capitalization, it's a huge company. And for small companies to grow, it's much easier. For bigger companies, much more difficult. And if we look at revenue here, it's 7.5% growth and 15% in earnings for the last 5 years. And if you look at similar number to 10 years, so it's kind of steady growth. Before we looked at company which called Hershey long time ago, and Hershey would be one of these companies where you would just invest your money for your kids. For example, you, instead of going to some kind of insurance company or bank, you might just buy 1 or 2 or 5 shares of this company and put it every month to your child's accounts, for example, and every month you buy, and regardless if it is high or low, you kind of average your buying price in any way, but you can expect that this type of company will grow. And in 15 years time, when your child becomes like adult and will go to uni and will need money, you can give him all the shares, and they can do whatever they want with them. Okay, so some people do this way. Now, the future revenue is going to slow down. That's based on value line report. And we can see that 4.5% on the sales, but still earnings they expect to grow faster than sales. And it's a good sign for us. Also, company paying dividends, which is also nice. Twice a year, we're getting dividends here. Now, if you look, that's where I got this information that company owns ABC and ESPN 44%. You always can read it here. Also, you see that who owns the company here. And when you read about it, you understand why the company is losing its price, because they lost millions of subscribers over the past few years, and will likely remain the casualty of ongoing cord-cutting trends. Okay, so we can expect that network may struggle due to wavering advertising revenues. So for us, and you can see that Netflix and Marvel, they're looking for kind of team up here as well. So uh, this type of information, it's important for you, because after you're analyzing other companies, and we're going to look at Foxa, and Times Brothers, you will see that they actually have similar problems. Foxa has lost quite a lot of subscribers, and you always ask questions, where do they lose them? And then we look at Netflix, and you will see that Netflix for the last couple of years, they were getting quite a lot of subscribers otherwise, and not only in United States but internationally. But for the last year, they slowed down, and it's kind of a good sign for us because maybe Disneyland and Foxa and other companies, they did something to retain their clients, or maybe it's just saturated markets already. It's quite difficult to get new clients, or maybe there are certain contracts that people can't move because they're trying to lock you for several years, and if you leave, you pay some penalties, and of course people don't want to do that, and they stay. It's similar to in Australia when you sign up for different like electricity, internet, and etc., etc. Okay, so that's fundamental. Now, when I analyze the now I'm going to open this value line. So industry rank, Dina was asking, 87. Timeliness 3, safe 81. Debt, I put total debt because for me it's important to know total debt. It's 13%, so it's quite good in any way. So compare with for such a big company, so it's kind of beta in value line it's 1.5, 1.05, whereas in we saw in Yahoo Finance it was higher. Okay, then we put this growth rate. We can see that it's constant growth of sales for the last 5 years, constant growth of earnings for the last 5 years. So we get the highest score here. Okay, 4, which is good for us. And management profit increasing, management solid. They handle all these challenges and they're operating smoothly. I'm sure there are quite a lot of lawsuits, but they're kind of not major. Okay, so the company by quality got 44 points, which is good. So it's stable, good, solid company. All right. So and for us, we're trying to find these companies. And when you find a company like that, and regardless what kind of price is going to be in this particular, always put it on a watch list, because sometimes the crisis you can see like Brexit or any other event, a market event which affects all companies, you can buy the company on discount. Okay, so that's why I always create a quality watch list where you keep your companies. So then we look at the price. So company pays dividends, so it's less than a half, quite healthy. And we can see that value line expect that the company will grow only 9% over, so it's not 15%. So it's kind of not great if you're trying to get momentum and the growth, fast growth. So it's kind of disadvantage here. So it's good that earnings growth always faster than sales growth. When we look at price earning ratio, we can see that price earning ratio was average 15, 13, 17, 18, 20. Okay, we can see that it gradually was growing towards last years, and now it's dropped. Now it's only 16.8. So it's kind of on the lower end, would say. It's not as low as 13.6, but it's kind of much lower than 20 and 18 and 17. Okay, so it's like if you take it, and more kind of when we try to look at in more details, well, is what do we look at highest points, we look at lowest points, we look at earnings, and we try to understand, okay, what kind of multiples company was trading during that particular year. So if the earnings was $2.5 and the price was moving from 28 to 44, so if we start dividing, we will see what kind of multiples we can get. Okay, price earning ratio on that particular year. But for us important not one year, so for us important the whole range. So that's why we always get average high, average low, and then average earnings a year, and then we divide. So we divide, okay, at average, if we take the lowest points during last 5 years and divide by average earnings, what would be price earning ratio at the lowest level? And we can see that at the lowest level, average low would be 15. Okay, so that's how historically um, um, Disneyland was trading at 15 multiples. Okay, so when you get any earnings, you multiply by 15, you get the minimum. Now, sometimes, although company will go into 78 in average, and we divide by earnings, and we get average high 2150. So, and of course, what we do in order to identify the gaps between buying and selling price, what we do, we take, okay, what would be the best case scenario? And best case scenario would be if the sometimes in the future company will go to the price with the same multiples, would be 21.5 times higher than its earnings. And then we look, okay, what kind of earnings company expects? And we take it from value line. Yes, I'll show you now. So here we can see it 7.35. That's what company expects to have it in 3 to 5 years. And in this case, we get this number. So when we multiply, so we can expect that sometimes in the future, if the company is going to make this type of money, and if the company will be trading at the highest multiples, so the share price will likely to achieve $158. Okay, and then we'll look at worst case scenario. What happens if the company is not going to grow and the earnings will stay on the same level as last year? So actual earnings. And last year we had $4.9. And then we'll look, okay, and what was the lowest multiple which company was trading? And it was 15. And when we multiply this, we come up with number 74. So we can expect if the company is going to generate same income as last year, not less, not more, right? And it's going to trade at the lowest multiples. So we can expect that the share price drops to $74. And after that, when we see the lowest possible level and the highest possible level, we divide it by 3, and that's what we get. Okay, the buy price until $102 until 130 hold, and then already we consider to sell. It will be already at house level. And then we try to identify our risk and reward. So we can see that for us, from $92, which is current price, to go to 158, we practically here get what $66, right? In potential growth, 65.73, or we have about $18 in drop. So the risk of losing $80 in capital or getting 65, you can see the reward is much higher than risk. It's 3.6 times higher. And it's good for us. We're trying to find companies which have this difference at least 3. And here we have 3.6. Okay, so so as I said, book value is 27, but you can easily deduct 25% from it because we looked it's goodwill, so it's intangible. Tangible book value would be much lower, and earnings would be 10th of November, so we have plenty of time to do any type of activities. And sorry, we see that the price valuation using TACN table, we can see that it's 43. So it's kind of good time to enter the position and buy it. That's using fundamental analysis. Now, another thing I want to mention about this particular company about earnings. Now we know I always tell you that guys try to avoid companies, don't buy it on before earnings, because during earnings you will see some surprises, and then the price might move up or might move down. Now it is different with Disneyland, and the reason for that, if we look at value line and we look at earnings predictability, you can see this one, 100%. So it's like they're right 100% time. So if they tell they're going to make this money, they make this money. Or maybe the difference is very insignificant. Okay. And it means that you can't expect huge moves during the earnings. So it's quite safe to carry this stock through the earnings. Now, but if you think about it, what can affect the price? Most likely, it's similar to companies like, for example, Apple. You see, they introduced new phone, and the share price moved within a few days 17% up. Okay, that's how. And in this particular case, probably it would be some reports on their new movies, and for example, they introduce new movie, and how many people went to see this movie. Did it hit the expectation or it didn't? Okay, and that's what can affect the price in the short term. Okay, that's how you can, if you see that they're going to introduce some data about the, let's say, Disney parks or movies or something else, and you know that this news is coming up, not financial data, but the news about how many people bought their product, that's what might affect the price. Okay, you need to pay attention to that, and it can give you opportunities to enter this position. Okay, so it's pretty stable, good company, and based on fundamental analysis, it's kind of good time to enter this position. Okay, guys, do you have, if you everything is clear on fundamentals, put a green tick. If you have any questions, put red cross and ask the question in chat. All right. Okay, perfect.